The first meeting is really a get-to-know-you meeting. We're going to sit down. Typically, the meeting will last about an hour. We're having a conversation. My job is to ask them some questions about where they are, what some of their goals are, what some of the key objectives they have in meeting with me, where they are to this point, and really what brought them in to see me. And now I'm at the point in my career where I have a lot of people that are dependent upon me to provide them with all the guidance and all the advice that we do on a day-to-day basis.
You spend your working years trying to build up your assets, trying to build up pension credits at your job, trying to grow your nest egg so that you can one day retire when you can't work or don't want to work anymore. And that's a period followed by phase two, which is retirement. And your priorities in these two phases are very different, but many times we see people don't make that shift and they still act like they're in phase one when they really should be acting like they're in phase two.
We're going to talk to you about what we commonly refer to as the second half of the game. And what I mean by that is you're working your entire life towards retirement, and I'm assuming that most of you are, at that age where you're starting to consider some of your options as you move into retirement. And as you do that, you're moving from what we call the accumulation phase of your life, where you're accumulating your assets. Maybe you're participating in your company's 401k, maybe you're contributing to an IRA account or a Roth IRA account or some type of retirement vehicle. And now, as you retire, you're transitioning into the distribution phase, or the part where you're going to need income in retirement. So we're going to talk about some different ways to do that with an emphasis on Social Security.
Hello and welcome to Financially Speaking with Jeff Bush. My name is Barry Warrenker and I'm the host of today's show. And today we're going to talk about one of our investment strategies, something we call portformulas. And portformulas is really a hybrid word. It's a cross between a portfolio and a formula. And Jeff, it's a tool that we use to manage volatility, and that's going to be the subject of today's show.
Yeah. Well, hello, Barry, and welcome to the show. Certainly are excited today to discuss the nuts and bolts of portformulas. And of course, we're always excited to be here on PCTV, our home right here in Pottstown, and of course on the World Wide Web at thepctvnetwork.com. Looking at 2015, Barry, it certainly was an interesting and also a volatile year. And we have a chart here that we're going to start off with. The year ended almost exactly where it started. So if you went to sleep at the stroke of midnight on January the 1st, 2015, and didn't wake up again until December the 31st, 2015, you would have seen the broad S&P 5 index down a fraction, actually about 0.7%. You can see here on this chart that it was essentially flat. Unfortunately, in between, we experienced a lot of volatility, as you can see on this graph. This is very unsettling for investors, which has become very commonplace. In fact, if you examine the S&P since 2000, you'll see that volatility is very common. And we like to say, this is not your father's stock market.
Okay, well, let's look at that, get a shot of that, the year of 2015. And if we look at that, you kind of can see pretty quickly that the end result for the year was we went nowhere. But along the way, it was an adventure, and we could see where the August, I guess that's basically July, August period of time, maybe some of September, things really seemed to be going south, and a lot of people were getting a little panicky at that point in time. And that speaks to the whole concept of why, and we'll get more into why we invented portfolios, as to take some of that emotion, take that emotion out of the decision-making process. Because when you look at this graph, your gut says, while it's on the way down, say, geez, where's the bottom? Am I going to keep falling, or what's going to happen here? And you need non-emotional tools to make good decisions. It's very hard to make them strictly on your gut. So we in managing portfolios and using our system. Explain a little bit about it, how we approach it.
Well, Barry, it really comes down to three simple questions. So number one, what do you own specifically? Why do you own it? And what is going to trigger a change? What's your exit strategy? And that's really what Portformulas is. It's a system to buy stocks and ultimately get rid of the stocks.
Well, you know,
it's done based on these formulas that we use, the strategies that we're going to go into today.
Right, and buying stocks, I know for many people, it's kind of the fun part of investing. You know, you feel optimistic and you say, gee, I'm looking at this stock or this investment and I think it's going to make money and I think the market's going to be good to it or it's going to perform well relative to the market. So it's kind of generally a happy time. You're in love with the investment. But then, you know, like any relationship, it goes through turbulent times and it never goes up and down in a straight line. So that's a strategy is necessary to manage it. So you had mentioned it's not your father's stock market. Now we saw that earlier slide where things were going very well for a good long period of time, and that was basically our father's stock market. And now what we're talking about is what is today's stock market like?
Well, yeah, what I mean by that is if you look at the stock market of the past 15 years, from 2000 to 2015, as you can see here on this chart, you'll see that you existed in a very volatile period, which is very different than the previous 20 years from 1980 to 1999. On the slide from 1980 to 1999, if we can advance to the next slide, you can see on the slide from 1980 to 1999, we had a nice upward slope, a very nice bull run, if you will, which is very different than the slide that we just showed. If we could get that slide back up again, the one we just had. Yeah, so this is today's stock market. This is a very different period of time that we're operating in. We're seeing a lot of volatility. And because of the volatility, it's really what we would consider unprecedented volatility. So if you look at any of the statistics, any of the data that we follow, the charts and the graphs, that kind of thing, you'll see that the volatility that we're experiencing today is like none other. So if you're retiring in this type of market, what do? It's very different.
Let's go back to that for a second. I mean, it's an important point because when we saw those hills and valleys and the peaks, it's one thing if you're 30 or 40 years old and you're investing in the market, you're working, you're not depending on the stock market for your paycheck. But as you approach 50, 55, 60, and now you built something, because you've been putting money aside, and now you have something to lose, number one, and number two, if you're going to be living off that money, if you're pulling from that account while it's going down, what happens then? You get a double whammy. You're not only losing money because the market's taking you south, but you're spending that money because that's what it was there for.
It's a death spiral.
And it really is tough to overcome. So that's the big issue for clients, especially our clients who oftentimes come to us as they get serious about retirement in their 50s, their 60s, and that's got to concern them.
Yep. So you might want to ask me what happened in 2000.
I might want to.
Yeah.
Especially if I was paying attention.
Yeah.
The 2000 was a very strange time.
So Barry would ask me, why is this? What happened in 2000? And Barry, funny you should ask that. The year 2000, in many ways, seems like a lifetime ago, and yet in other ways, it seems like yesterday. In fact, my daughter was born in 2000. We call her our Millennium Baby, and just in a few short weeks, she's going to be turning 16, and she's going to be learning how to drive a car. When we were approaching the year 2000, you may remember some of the fears that we had, and of course, here on this chart that we have up here, this is actually the headlines, January the 1st, 2000. All banks will fail. Food supplies will be depleted. You know, this is like doom and gloom. Electricity will be cut off.
I remember this. People were literally, their
They were
computers were going to
scared.
crash. Everything
The
was
stock
going
market will crash. I mean, like I can remember people getting all these like generators to make sure, you know, they had power backup. And
Well, it's, you know, they say comedy is tragedy plus time, but at the time it was very scary. Now we can look back and laugh a little bit about it. And if you think about it, Jeff, our company, Informed Family Financial Services, we chose to open our doors right in the middle of all this stuff.
Yeah.
We opened our doors on January 1st of 2001, and these headlines were screaming at people. Banks are going to fail, electricity will be cut off, telephones won't function, your computer will melt down, your vehicle won't work. And that's when we decided that, hey, this is a good time for us to go in business and help people with their retirement planning. And looking back now again, you know, when you look through the lens of history, we realize, hey, you know, that was a courageous thing on our part. I think maybe we were, you know, just were confident that these kind of things would be worked around. As you know, as we look back in history, there have been many panics. There's been many times people thought the sky was falling, and those who can, if you can keep your head when those things are happening, oftentimes there are great opportunities to be had. If you can, you know, act not out of fear and emotion, but act out of facts and figures and logic. And that's like a perfect lead-in for what Portformula is about, because we're trying to take the emotion out of the decision-making process when you do your financial plan.
of course, as we entered into the new millennium, the stock market would never be the same. So 2000 was really a turning point. And as we sit here, you know, 16 years later, we're seeing more of the same. We're seeing, you know, all this volatility in the market, you know, with China. Now it's China and oil prices and, you know, just a lot of turmoil in the foreign markets.
And you know, when you think about it too, while this is going on, back in, you know, in the year 2000, if you're 65 years old or 60 years old or whatever, or you're ready to retire, and this is what you're retiring into. And what we saw was a lot of people, once they got a taste of what could happen in a correction, many people just pulled out of the market and said to themselves, well, we're not going to be in the market, we're just going to play it safe, and we'll buy those good old-fashioned CDs that mom and dad relied on as part, you know, for their life, because they go to the bank and take out a CD that might pay 8, 10, 12%. Why would you want to be in the stock market, especially a volatile one, if you can make 8, 10, 12% on a CD?
Yeah. Well, let's remember that this is not your father's CD market either. So if we look at CD rates on this next graph here, you'll see, you know, you remember when the CD rates were double digits. So if you look back in the early 80s here, we had double-digit returns on your CD rates. And now a one-year CD is 1%. And, you know, you have to go all the way out to a 5-year CD to get 2%.
Right, and then you factor in that 2% is taxable, so you're giving back some of that. And what's inflation, you know, when you're making 2%?
And low rates and lack of liquidity means people have a lot of investments in cash. So that leaves, you know, a lot of people are operating in an interest rate environment that is not very favorable.
It's tough. It's tough for people, and you know, you realize, you know that you need to make some money on your money. That unless you're sitting on a couple million and you're not really worried about it, I mean, if you have a few million and you're happy just making nothing on it, you know you're not probably going to run out of money unless you're spending a heck of a lot more money than most people do. But for most folks who have a nest egg, they can't afford to sit by and watch it only gain 1 or 2%, because really in reality it's losing money because of inflation, and also they're depending on that money for income to supplement their Social Security. So it's a tough market for people that have something to lose to manage. How do you manage your emotions? How do you handle things like the news headlines that we kind of? It's kind of funny now to look back on the news headlines of 2000, but literally, it's very difficult to open the paper and not hear something negative going on. If you read any of the business sections or the main, there's always a crisis somewhere.
Yeah.
It was Greece for a while. Now it's the UK. It was, there's always a crisis in the offing. And do we wait until it's a perfect time to invest when there are no uncertainties? Well, that time is probably never going to come. So how does Portformulas work in this kind of situation?
Well, the way, so we'll talk about that. We have tools to do this, Barry. We have a trending tool we call RAM, and we're going to show a chart here in a second of what RAM is. And RAM is an acronym that stands for recession and market. So we go through a calculation every month to decide whether the market performance dictates whether we should be in or whether we should be out. So the red. So hopefully people are watching this on a colored monitor, because the red means you're out and the green means that you're in. So the significance of this chart, you can see here that we missed the two major downturns that we experienced in the last 15 years. So the one in the early part of the century here that was precipitated by the technology bubble burst, and also 9/11, you'll see that our scoring system had, which we call RAM score, was in the red, and in that period of time, the broad market was down about 30%. And we missed that.
Yep.
Okay.
And that's really, really major, because again, if you're at or near retirement, if you're using the money for some income or soon to become income, you can't afford generally to suffer a 32%, 32.5% correction and expect to be able to grow your money back and come out ahead, especially if you're taking any money from it. So when you say Portformulas does a calculation, it does really dozens of calculations of a lot of different factors, none of which are on your emotions. None of those factors they're all numbers, they're all facts and figures.
They're all it's formulas.
Formulaic.
It's formula driven. So there's like 7 different points of data that we look at to calculate, and some of it is economic data and some of it is market data. But it's all, data that, it's like kind of like baking a cake. It's all these ingredients that go in to determine whether we're in the market or not. And if you think about it, if you can say, well, geez, we avoided that big downturn in 2000, and then we avoided the other one in 2008 and 2009, that's pretty significant.
Absolutely. And again, it's a strategy we use. We're not trying to time the market. We're not trying to pick the exact time we want to be in, the exact time we want to be out. But we are measuring, as you mentioned, many different factors to determine, A, do we want to be in the market at all? And B, if we don't want to be in the market, if we do want to be in the market, which individual stocks are we going to own? Now, many people out there are familiar with mutual funds, and they maybe own some mutual funds. And there's some good mutual funds and there's some not so good. But all of them, because of the way they're structured, you don't own an individual stock. What you do, you own a share of that mutual fund's portfolio, the whole portfolio, the good, bad, and the ugly. And it's not just making a monthly decision whether to be in the market, whether to be out of the market, and it's not making a monthly decision which stocks it wants to own this month. So it's a very different animal when we use Portformulas. Our clients, they can look right on their computer and see what they own today, and how many shares of each stock they own. If there's a bond component, how much they have in the bond component, and it's actively making these decisions that our emotions make very difficult to make those decisions when, it's, we're human beings. We have feelings, we have sentiments, we have fears, we have optimism. We have all these things that are emotional that and if we happen to get optimistic and optimistically emotional at the right time, we can make a lot of money. If we happen to get pessimistic at the wrong time, we can end up, missing out on great opportunities. So having a formula that is going through this process for our clients on a regular basis, and really sifting through, and our clients know, well, they know where they are each month, they know what they own each month, and we're not trying to beat the market, whether you call it the S&P 500 or any index, but what we're trying to do is avoid the catastrophic losses and hit those singles and doubles that give us a good steady return and avoid those losses. And that chart you showed earlier, going back for the period of 15 years, where one chart, the S&P 500 would look like a roller coaster, a ride to nowhere, and our chart really was more of a steady eddy. Avoid the losses, get the gains. Avoid the losses, get the gains, and really outperformed over those 14 or 15 years.
Oh yeah, absolutely. So the question then becomes, well, what happens if we're not in the market? Where are we? And the answer to that is, we have two choices. We can either be in a bond strategy or we can be in cash. So the early generation of portfolios, we used cash, but then as interest rates went down, we found that the trend looked better if we went to a bond strategy when we weren't in the market. So that's what happened back in 2001, and actually again in 2008. And of course, we're not in the business of making predictions. It's actually, this is just consistent money management in a market that is really impossible to predict.
And also, it's important to note here, Jeff, that port formulas is one tool in our toolbox of planning. And when we help people plan out their retirement over a period of 20 or 30 years, and we could talk about how people are living a lot longer, so it becomes even more critical to have a plan. Oftentimes we'll place port formulas in a part of the plan where maybe it's going to provide income even 10 or 15 or 20 years down the road. We don't like to rely on the volatility of the stock market if it's short-term money. So again, we use a system that we call the asset cycle portfolio, and it usually will have 3 or 4 different parts to it. Each investment has a job to do. One investment might be to provide the short-term income that they need. Another investment might be to provide the mid-term income that they need, and another one to provide income further down the road. And port formulas, we like to have a good amount of time, because the market we believe is going to be volatile, and you don't want to have too short a window. You're going to have to ride out some volatility, and it's our job to talk to folks and make sure that they have some comfort with the amount of volatility they're going to deal with, and understand the risks involved, and that we're going to try to manage our way through it. And we've done a great job in the past, and we'll continue to do our best to do a great job in the future. But I think the more volatile the market is, the more negative things you hear, the more nervous you may be, the happier you would be to look at a non-emotional decision-making system that keeps you in the game when there's singles and doubles to be had, and maybe puts you on the sidelines when the Phillies are in a game that they're getting beat 11-2. It'd be nice if they could just step out of the game and not have to take that beating and maybe start over again. But portfolios, it can give you a do-over. I mean, the market corrects. If we sidestep it and instead of losing 30 or 40%, make a 1 or 2% return. Well, that's a huge thing for folks, and we're pleased with that.
Yep. Well, if you want more information on port formulas, You can email us at info@informedfamily.com or give us a call and we'll get you a report, a Port Formulas report. Now, let's talk a little bit about us. So Informed Family Financial, we do a lot of public workshops. We're going to be in the area. We're going to be in the neighborhood. We have a seminar coming up, as you can see here on the screen. So if you're interested in attending one of our workshops, you can call our office for tickets or email us, and we'll be sure to get you some tickets. So it's nice to get out and meet the people. We've been doing this for 16 years now, seminars in various venues around the area, and it's really been a lot of fun.
It's a great way to meet people. It's a great way to keep our finger on the pulse of what people are interested in, because we get a lot of feedback in these seminars, and people are hungry for information. They're looking for ways to make sure their retirement is one that's a successful retirement. There are no simple, easy answers, but there are a lot of good answers and a lot of proven ways of doing it that we've employed, and we love meeting people at these workshops. A lot of people are, they want to know more and more about Social Security, and they're realizing there's a lot to be had in Social Security above what the Social Security Administration will tell you, and we cover some of that in these workshops and try to keep it interesting and fun. So once again.
Yeah. Well, I would just say, retiring today is complicated. There's a lot of information out there. Social Security is one important element. We talk a lot about that. Today we spent a lot of time talking about our investment strategy, Port Formulas, which is one of many things that we do for our clients in terms of implementing a comprehensive plan. So with that being said, we're going to sign off here today, and it's been a pleasure talking about Port Formulas with you, Barry, and we'll see you next time on Financially Speaking.